Welcome back everyone, and in this video we're going to go over the best 3 sectors to buy in 2021 according to Mr. Kevin O'Leary. He's well known for his role on the hit show Shark Tank, and he's also the chairman of O-Shares ETF Investments. He's well known in the financial world and has an estimated net worth of over $400 million. He's famously known for being on TV, discussing the equity markets, and sharing his opinion on how he believes the overall stock market, bond market, and commodity market are going to perform down the road. And he recently did an interview with Kitco News where he shared his top investments for 2021, and we're going to play a short clip where he lists the 3 sectors he believes are going to outperform and be the winners in 2021 and beyond.
What about these stay-at-home stocks, as we were just talking about? I don't think they're stay-at-home stocks. I think they're work-anywhere stocks, and I think they're going to continue to perform. And so technology is one of my go-to sectors for 2021, as is healthcare, as is the consumer. Those are the 3 areas.
So for 2021, Kevin O'Leary likes the tech sector, healthcare, and consumer brands, and he has been reducing his weighting in real estate and deploying that excess capital into these faster growing sectors. So what we're going to do in today's video is evaluate the growth of the tech sector, healthcare, and consumer, and predict what we expect they're going to do down the road. We're also going to take a look at each of these individual sectors, look at the top companies within each, and I'm going to share with you in my personal portfolio what stocks I own from each of these 3 sectors. I'm also going to share with you how much I have each sector weighted in this portfolio as well, to give you a little bit of an idea of how I'm investing compared to what Mr. O'Leary predicts for next year and beyond. And the simplest way to compare each sector's performance is by using Vanguard ETFs. Vanguard is known for offering some very low-cost ETFs that perform very well. So for the tech sector, for example, we're going to use ticker VGT, which is Vanguard Information Technology ETF. And the tech sector has grown 44% in 2020. So that's how we're going to evaluate each of these individual sectors, by using a very simple, low-cost Vanguard ETF that has been a market leader for many decades in the past. So if you're new to the channel, I am the Gen Z investor, and every single day we talk about the stock market, we go over different stocks you can buy and sell and discuss any major market news or headlines. And of course, in today's video, we're going to take a look at Kevin O'Leary and his prediction that the consumer sector, healthcare, and tech will be the winners for 2021. So if you're new, please hit that like button and subscribe. I post every single day about the market, and now we're going to jump right in and evaluate the tech sector and how we think it's going to perform in 2021. So 2020 has been a crazy year. The transition into the stay-at-home economy has really been a strong boost for the overall tech sector, which has grown 44% this calendar year. If we compare that to the S&P in 2020, it has grown at around 15.8%. So we know tech is really a strong driver, bringing the market even higher. And ticker VGT is Vanguard's Information Technology ETF, a very low expense ratio on this sector at only 0.1%, and overall they have performed very well. If we take a look at some of the top holdings in this ETF, you have Apple, Microsoft, Visa, Nvidia, MasterCard, PayPal, Adobe, Salesforce, Intel, and Cisco. These tech companies have really been driving the market even higher, and this ETF gives you a bunch of exposure to different industries within this sector as well. You can see around 22% of this ETF comes from hardware and storage. Software makes up around another 20%. Semiconductors, one of the fastest growing sectors in the market right now, makes up around 16% of this ETF, and various others make up smaller parts. So you can see this overall tech ETF is nicely diversified within various different aspects of information technology and has performed very well. If we take a look at the historical performance, you can see this ETF has grossly outperformed the S&P 500. Starting 10 years ago with $10,000, the yellow bottom line represents the S&P 500 and the blue represents the tech sector. So we all know tech has been on a boom, and over the past 10 years, a $10,000 investment into this ETF would have grown to over $64,000. Meanwhile, the S&P 500 currently sits at a value at just over $37,700. So this has really been the tech boom. Over the past 10-year bull market, we've seen nothing but growth from the tech sector, and you can see it has grossly outperformed the S&P over that timeline. For the past 10 years, this ETF is averaging 20% annual returns, which is absolutely incredible. And since its inception back in 2004, it's averaging close to 13% per year annual growth. So information technology has been on fire, and in my personal portfolio, tech stocks make up around 37%. I have close to $30,000 within the tech sector, and you can see it makes up more than a third of my overall market portfolio. And the 4 tech companies that I own are Apple, Microsoft, Visa, and MasterCard. And if we take a look at VGT's top holdings, you can see that I actually own 4 of the top 5 holdings in this ETF. So I'm a big fan of low-cost ETFs. Although I own a dividend growth portfolio, I have other smaller investment accounts solely based off dividend-paying ETFs, sector ETFs, and overall market index funds. I'm a big fan of the passivity of an ETF, and I do like that in my personal portfolio, I'm holding the 4 of the 5 largest companies from the information technology sector. So those are the brands that I own, and you can see it makes up over a third of my portfolio, really weighted towards those 4 companies. I like tech stocks that pay out a dividend. All 4 of the companies that I own pay out a very slight dividend, averaging around 1%. And you can see they have performed very nicely for me, now making up more than a third of this portfolio. And the other 2 sectors we're going to go over today are healthcare, which makes up around 10% of my portfolio already, and consumer. And I'm actually going to combine both consumer staples and consumer discretionaries, which if you add up the 14.8% and the 6.3%, combined consumer sectors make up around 20% of my total dividend growth portfolio. So if you take a look at this, 20% allocated to consumer, 37% allocated towards tech, and 10% towards healthcare, that means around 67% of my overall portfolio is allocated to these 3 sectors of the market. So 2/3 of my investments and my stock market holdings are within 3 sectors, and those are the 3 that Kevin O'Leary predicts are going to outperform in 2021. So that makes me feel very comfortable. I like the holdings that I own. I like the companies that I own because they're all solid blue chip names. They all pay out a dividend that grows each and every year. In every single year, I evaluate all my companies and take a look at their balance sheet, their income statement, go over the company's financials to determine if I believe they are still safe investments that will continue to perform and expand down the road. So far, I'm still loving all my companies. Even during this hard time in 2020, none of them were too harshly affected. They all continue to generate nice revenue and income. They've all continued to pay out their dividend, and a lot of them have continued to increase that dividend payment even during this tough year. So I like the companies that I own, and I feel very comfortable that 67 to 68% of my portfolio is allocated to these 3 main sectors. So now if we move on, we're going to take a look at the healthcare sector. So Vanguard Healthcare ETF is ticker VHT, and this sector has grown over 16% in 2020. So they have just slightly outpaced the S&P 500 by around 0.3%. So really mimicking the performance of the S&P index in this year. So right now this ETF pays out a 1.22% dividend and has a very low expense ratio at 0.1% as well. So all 4 of these ETFs have that very low expense ratio, very minimal, and doesn't really notice off your total returns. If we take a look at the top holdings in this fund, you can see Johnson & Johnson, United Health Group, Pfizer, Merck, Abbott Laboratories, AbbVie, Medtronic, and a few others round out the top 10. So if we compare these top 10 holdings to my personal portfolio, I own 4 healthcare companies, which are AbbVie, Johnson & Johnson, Merck, and Pfizer. These 4 healthcare brands make up around 10% of my overall dividend growth portfolio and are nice, stable blue chip names. So I own 4 of the top 10 holdings, once again making me feel very comfortable that if Vanguard has these companies as the top weights, that I am picking some good winners for my personal portfolio as well. And if we take a look, this healthcare sector is broken down into some healthcare equipment manufacturers, biotech, pharmaceuticals, managed healthcare, and many others. If we take a look at the performance of this sector over the past few years, you can see the blue line represents the healthcare sector. It has slightly outperformed the S&P as well over the past decade. And if we take a look, they average over 16% per year growth over the past 10 years. And since its inception back in 2004, the healthcare sector has been growing at around 10.5% per year. So another sector that has slightly been outpacing the overall S&P. It's done very well over the past 10-year bull market, and we can expect it to continue to perform down the road. In my portfolio, my 10% allocation is comfortable for me. I will keep the healthcare sector between 8 to 12% of my portfolio at a time, and I may add one other name in this portfolio as well. If we take a look, BMY is the 10th largest holding in this ETF. Warren Buffett has been buying this company, and I actually made a video about some of the cheapest and most undervalued companies on the market right now, and Bristol Myers Squibb was included in that list. So they've been very attracted to me. I have them on my personal watch list, and this is a company I may add to my portfolio over the next few weeks. So that was the healthcare sector. Now if we jump over to the third sector, we have consumer. So the consumer sector as a whole is broken down into consumer discretionary and consumer staples. So Vanguard has one ETF for consumer staples called VDC, and consumer discretionary is called ticker VCR. So I'm going to combine both of these for my personal portfolio and just share what I believe the overall consumers are going to do down the road. Personally, I am bullish. I've always liked consumer staples, especially with how crazy 2020 has been. People bulking up on necessities, the stay-at-home orders, people scared thinking stores are going to be shut down. Consumer staples have really done very well because people are loading up. They want to keep more excess products at home because they're worried about any type of lockdown. And I don't think those fears are going to go away anytime soon in 2021. So I think consumer staples are going to have a solid year. So far, this is the only sector of the four that we're going to go over that has actually underperformed the S&P, returning a total of 7+% in 2020. Consumer discretionary, on the other hand, has seen an accelerated growth, best performing sector actually outperforming the tech in 2020 by just under 1%. This sector has grown 45.5% this year and overall sits at all-time highs. So if we take a look at the top holdings in the discretionary ETF, you can see that Amazon, Tesla, Home Depot, Nike, and McDonald's round out the top 5. In my personal portfolio, the two companies I own from this sector are Home Depot and Lowe's. These are two retailers that I believe are going to continue to dominate for many years down the road, and I don't think they're going to slow down anytime soon. And you can see consumer discretionary makes up around 6.3% of my portfolio, and the only two stocks that I own in this sector are both Home Depot and Lowe's. If you were to add up my two market values in this company, you get just over $5,000, which is the 6% that you see here. So those are the only two retailers that I chose from this sector because I am a believer that retail is going to slowly reduce in size. I don't think retail is ever going away, but I do think traditional retail has been changed forever from 2020, and I do think it's going to slowly see reduction in total retail space, revenue, and I think net income is going to decline. So these are the two retailers that I actually don't think that trend is going to harshly affect them. I think Home Depot and Lowe's sell home improvement products that you're actually going to have to go in and physically see. I think it's going to be very hard to transition to fully buying these types of products online. And comparing how things look for your house, it's better to see them in person on display. And that's how I believe these companies are going to remain operational and their large in-person retail stores are going to continue to dominate. Both of these companies did see some accelerated online e-commerce growth as well. And we just got a report that up to December 24th or Christmas Eve, online e-commerce sales for Home Depot and Lowe's were up close to 80% this year. So that just shows for the items that you can shop online for these two big names, people are, but I don't think their in-person retail is going to be hurt too much from this transition in consumer spending. The other names like Amazon, Tesla, they do not pay out a dividend, although I do really like these companies and I do own them from other S&P 500 ETFs I own in smaller accounts. I do not own them in my personal dividend growth portfolio. Other companies like Nike, it is trading at all-time highs. Their online e-commerce platform has accelerated this year, and it is somewhat an idea that I have on my watch list that if we see a dip in this company, I may add to my portfolio. If we take a look now at this industry's growth, you can see the top blue line has grown to over $51,000 on your $10,000 investment 10 years ago. And of course, the S&P 500, like we've compared to all of these ETFs, only grew to around $37,700. And if we take a look over the past 10 years, this ETF has averaged more than 17.8% annual growth. And since its inception back in 2004, this sector has grown by around 11.7% per year. Now, if we take a look at the consumer staple sector of the market, VDC, this is the only sector of the 4 that we looked at today that actually underperformed the S&P this year by growing by only 7%. Overall, the top companies in this portfolio are made up of Procter & Gamble, Walmart, Coca-Cola, Pepsi, Costco, and many more. And in my personal portfolio, if we take a look, this sector makes up around 15%, and I own 4 consumer staple companies. And those brands that I own are Costco, Pepsi, Procter & Gamble, and Kimberly-Clark. And you can see PG, Pepsi, and Costco are from the top 10 largest holdings in this ETF and are 3 of the top 5. I also own Kimberly-Clark. I do like the products that they sell. Similar to Procter & Gamble, they sell necessities that I believe people will need over the long term. And if we compare their performance, they're actually the one sector that actually underperformed the S&P over the past 10 years. The S&P is up to over $37,000, and the consumer staple ETF has only have a total return at just over $31,000 over this past decade. It's averaging 12% annual growth, and since its inception back in 2004, this sector has grown by close to 10% per year. So in reality, all 4 of these sectors have grown since their inception back in 2004 by at least 10-ish%. So to own an ETF that's growing at 10% per year, that's very strong. If you want to pick the solid sectors and you don't want to own the total S&P 500, these 3 sectors have proven to be strong holdings. They've proven that they can outperform, and these may be great additions to your portfolio for 2021 and beyond. So that's how we're going to wrap up today's video. We went over the healthcare sector, consumer sectors, and technology. They've all done very well in 2020. Kevin O'Leary predicts those are the sectors that are going to outperform in 2021. And as we saw, those sectors make up around 2/3 or 67% of my personal portfolio as well. So thank you for watching, everyone. I am the Gen Z Investor, and see you in tomorrow's video.